So in this video, I'm going to be talking to you about how to raise capital for your business. A business that you want to start, an idea that you have in mind, a strategy that you have in mind, and it's in your mind and you want to execute it. You want to take something that's a dream and turn it into a reality through execution, investing time, and attracting capital. So I'm going to be talking to you about principles of how to do that. A little bit of a disclaimer: this is a very highly regulated space. So whenever you are raising capital from an investor or a bank, there are laws around it. So you need to make sure you get a lawyer who's qualified to advise you on the transaction itself, and you get an accountant and you get an industry expertise who can help you navigate the whole situation, the technical aspects of how the funds would actually be raised, what's the basis, what's the structure, what's the terms. And in this video, I'm not going to be talking to you about the terms, but I'm going to be talking to you about general guidelines and mindsets of how to raise capital and the strategy to raise capital. And then you need to get these professionals' advice. So that's a disclaimer. If you're new to this channel, a little bit of an introduction. My name is Prithvi and I'm a founder of a healthcare investment company based in UAE. And our company focuses on acquiring multi-million-dollar businesses which are based in UAE and GCC region. And in the last 3 years, I have managed to negotiate a $3.5 million business acquisition, a $10 million business acquisition, a $25 million business acquisition, and a $120 and $140 million business acquisitions. These are the negotiations I have been in, and I've also managed to secure financial term sheets from the banks with an intention to finance. So banks actually stepped forward and provided with a term sheet that we can finance 50 to 70% of a $10 million transaction. So I managed to secure that. I've also done over 80 plus presentations with the banks. I have met several high profile bankers that have financed $350 million deals, and heads of corporates, heads of investment banking, head of commercial banking, head of corporate banking, bankers that deal with billion-dollar companies. Okay, I have talked to many of them and I've asked them some specific questions based to understand their lending criteria, as to what basis do they lend money on, what are the bank's policies. So I have a pretty fair idea and estimate, and I did this in UAE, so everywhere the laws are a little bit different, the policies are a little bit different, but generally speaking, banks have the same interest. The bank has, most of the banks are structured in a very similar fashion, with some minor, differences everywhere. So I'm going to be talking to you about how to raise capital for your business in this video. So let's get started. First of all, one of the biggest mistakes that you could make is raising capital based on something that does not exist. So, an idea that's just on piece of paper and you want to raise money based off that idea, it's not really practical. And even if you do manage to do that just based on a prototype or something that you created on a piece of paper, you will not get the best deal. And the investor or a bank that's putting up the money, bank is not going to put up the money, but an investor who's putting up the money, he will take most of the shares of your company, and then you will be working like a dog as an employee, where the investor just pays you the money and relaxes. So you want to avoid that. Even if you are successful, you are setting yourself up for failure and a lack of control. I think the reason you got into entrepreneurship is that you want to have enhanced control. You want to be your own boss. You don't want another major shareholder trying to push you around, especially when you are the one putting in all the work. So make sure that you're not just raising capital on a piece of idea. When you raise capital on a piece of idea, there is too many risk factors involved. There are too many uncertainties, and there is the risk index of the project is very high, and an investor is not going to value that opportunity as much, and they're going to ask too much of your company in exchange for too little money. And what will happen is you will start to execute on that, and then you will find that this money ran out. So, but you would have learned a lot of things by execution and by investing this money. So then when you go back to the investor to ask for more capital, they're going to give you a little bit more and take more of your company, and this process keeps repeating. So as the business model gets more and more refined and sophisticated and actually starts working, by that stage you have raised capital so many times and you've exhausted all your time, and the investor has all the control, and the investor has the position of having all this data that came out of actually your work. So you got to be careful of that scenario. It's just my personal preference. I don't raise capital based on something that's does not exist, or a plan that does not have proper feasibility. I've noticed in a lot of Shark Tank pitches, the type of people that secure the capital are most of the time the ones that are already successful, that have already a track record, that have started to make some money. And they initially started off with risking their own money. They created some profit, some sales, and then they go looking for some growth capital. That's a good scenario to raise capital. But again, if you raise equity from an investor, it's, they're going to take control of the company. So I would avoid this route completely. What I would do instead is I would raise capital, I would raise debt, and I would raise capital based on something tangible, something that already exists, something that's not a plan, something that's an asset. For example, a real estate that's already producing cash flow. Even the real estate that's just a land, an empty piece of land that's not developed, unless I'm an experienced developer, I would not get into that situation. I would find a company or find a piece of real estate that's producing a ton of cash flow, it's in a good location, etc., and it has all the risk factors covered, it's a prime location at a discounted price. Just giving you an example. I'm not into real estate, I'm into healthcare. So there are similar opportunities within the healthcare. For example, a dental clinic. Dental practices have 40% profit margins. And let's assume that you find a business and you don't have to create anything. You just have an existing business that is running for the last 15 years. And you have an owner that's 65 years old, and he wants to exit his business, and he's looking for a buyer. And he's willing to take a discount, because how many people do you know who are buying dental clinics? There is not a lot of people who buy clinics and healthcare companies. So if you manage to negotiate the price down and you agree on a small down payment and rest deferred towards the future, then all you got to come up with is a little bit capital. You're not creating anything from scratch. You already have cash flow that is in the business. You can see the cash flow on financial statements that they're making the money. You can check the bank statements, you can do a due diligence and check everything is legitimate, and you can see the money is already coming in. So the money that you will be raising from the bank is not towards creating anything. It's not towards creating value, because that's a risky proposition. It's about acquiring value that already exists in this world. What if I told you, you go into a store and you say, I'm looking for a t-shirt, right? You're an investor or a buyer. You say, I'm looking for a t-shirt. And the shop tells you, okay, you give us the money for the t-shirt, and then we're going to go make the t-shirt. And then we're going to give you the t-shirt. You're not going to accept that. You want a ready-made t-shirt. So just like that, when you go to raise capital, the investor is looking for where is the value, or the bank is looking for where is the value. And you say, oh, I just have an idea and I'm going to now use this money to create the value. They will obviously not be that inclined to invest. Okay, so you got to make sure that money is raised based on something that is tangible. Yes, you can raise capital based on an idea, people have done it, and then the industry comes into play. That industry has to be booming, and you have to have something really tangible. You have to have a team that's very experienced and have a track record, and they have to have actually something tangible once again to show that they have done something in the past, something similar. Okay, if you're someone like Peter Thiel or Elon Musk, you can raise capital based on an idea, but if you're someone starting out, it's very, very challenging. So you are better off identifying opportunities that have turned out well, that are profiting, that are cash flowing, and just acquiring those from them. And then what you do is you structure the deal in a very shrewd manner. You pay less upfront, remaining deferred. So the amount of capital that you're raising at the beginning is a very small amount compared to the cash flow of the business. And even the small amount of capital that you would be raising from the bank, you will be stretching it over a long period of time. And due to that, the yearly payment, the monthly payment is going to be very small compared to the cash flow of the business, and you can easily structure this deal. The other thing that the bank or your financier will ask you is about the risk scenarios. So they will ask you questions like, have you thought about risk? And if you say, oh, there are no risks here, everything is just fantastic and great, that argument will not work. You want to clearly disclose all the risks that are there in that company that you're buying, or in that opportunity that you are asking them to invest into. You got to clearly identify all the risks, and you need advisors who would be advising you on these transactions, and you got to write down every single risk, and you want to create deal structures that address all of these risks so that the whole thing is bulletproof, and then you present the opportunity with your financier. So you got to make sure that you're buying something tangible in an industry that's very stable. The other factor is the industry. Not all financiers would be interested in the industry that you're proposing. Nothing to do with business model, nothing to do with you personally. It's just that they're not interested in that industry. I remember I was making a lot of presentations, reaching out to a lot of people and a lot of funds. And one of the funds I reached out to, I was really pushing and I was really pitching. And then the fund said, listen, we don't invest in healthcare. We invest in healthcare technology. It's a very niche. Our fund is very focused on a very niche opportunity. So we are not allocating capital. We have the money, but we are not putting in that direction. Similarly, some banks were not interested in doing healthcare deals. They maybe had a bad experience. Other banks were very strongly for healthcare. We love healthcare. We have financed many deals in healthcare. We have made a lot of money in healthcare. Healthcare is on our positive list. So it really depends on the profile of the financier, the interest of the financier, and the policies within that financial institution. So to summarize, here is the order of the whole thing. You got to find an industry first that is booming. Right? Booming, big profit margins, a lot of opportunity. Then you got to create a business model. Okay. Then you need experienced advisors who have done what you want to do, and you give shares in the company, because initially you may not have the money. If you have the money, you can pay them. If you don't have the money, you can give shares in the company for their involvement. You want experienced guys on your team from legal, finance, accounting, and industry expertise. You have this, then you get a law firm, an accounting firm, then you start, talking to some of the financial institutions, getting some information, understanding their lending criteria, understanding on what basis they will give you money. It's always good to ask them questions and understand what they want. What do they get out of this transaction? What are their concerns? What are their fears? In what circumstances they will finance, in what circumstances they will not finance. Once you speak with a lot of the financiers, you get all of this information, you will have a pretty good idea. Then you go look for the opportunity. And then you structure that opportunity based on their preferences, their needs, their desires, and then you present it in the format that they want to see. You protect all the risk, you disclose all the information, you make sure you have quality information. You know, you want to make sure that if you're presenting financials of a company that you want to buy, they are audited financials. They are not prepared on Excel sheet. So the financial information is legitimate. You present the financial information, you structure the deal right with the seller, and then you raise capital based on the experience of your team, the track record of your team, and something tangible in your hands that you're buying at a discounted price. The true value opportunities are businesses which are very valuable, but they are purchased at a discounted price. And you want to pay as little money up front as possible and delay the payment to the seller as much as possible. Doing all of this, you will reduce the risk in the deal tremendously. The cash flow will cover the debt service significantly, and you have a very strong business case to present it with the banks and raise capital. So that's a little bit of an overview of how the whole process works. And ultimately, this is a numbers game. You don't ever have to, you should never depend on one bank. You have to have many contacts, and it's a numbers game. So you got to present a lot of opportunities to a lot of banks, and with every presentation you get good, and you can adjust and adapt based on every presentation. And eventually, when you have something valuable, you will get the financing. So get proper advice from lawyers, accountants, and a finance guy on these transactions. These are very complex subjects, and these are more than complex. These are this is a very highly regulated space. So if that's you, if you want to do something of this nature, if you want to learn how to acquire multi-million-dollar businesses using banks' money and leveraging other people's experience, I have a proposition for you. Reach out to me if you want to learn how to do this, and we will talk what can be worked out between us. So I'll talk to you soon. And if you're new to this channel, and if you haven't hit that subscribe button, hit that subscribe button, and I'll speak to you soon.